What do you see in flows in bonds? When you and Bob Michael look at the screen, what do flows look like?
Yeah, so we've seen some pretty large moves within the fixed income market over the last few months. So if you think about what the market was pricing in terms of recession probabilities implied within triple B spreads or the equity market, it was as high as around 80% in mid-June. Now that's down to about 40%. So we've seen a very large retracement in high yield spreads down to the mid to low 400s. And what we feel in terms of that movement is we understand why there's been a repricing. There is an increased probability of a soft landing. But at this point, this level of spread is really no longer protecting you from the still material risk of a hard landing if inflation remains stickier, which is our base case.
Okay, Kelsey, so where does that leave the Treasury market and how that's priced right now? Are you more comfortable with that? Chris Harvey of Wells Fargo wrote this in the last 24 hours, that April's 5 basis point inversion seemed to have got more attention than the almost 50 basis point inversion we had last week. Why do you think that is?
Well, we've been positioned for curve flatteners. I know I was last here on July 6th. We were calling for higher front-end yields on a flatter curve. The 2s-10s curve is now 30 basis points flatter. And we think that that makes sense. The Fed has done 2 supersized rate hikes. Now what we're looking at, so the market is pricing in the Fed funds rate getting to around 3.5% by the end of the year. That's basically in line with the Fed. The real divergence comes in 2023, where the market is pricing rate cuts and the Fed is expecting to continue to hike. And I think the minutes gave us some insight into that. I noticed one of the things that that stood out to me was the fact that there are a number of people on the committee that expect that once they get the policy rate to restrictive, they're actually going to need to keep it there for a period of time. And we are lean on that side, expecting that the Fed is going to need to keep policy rates higher because although we got one decent inflation report, we're still seeing a lot of wage pressure. And one of the data points that we thought really was underappreciated last week was unit labor costs, productivity adjusted wages, which is also still very strong.
Relative to previous cycles then, Kelsey, previous hiking cycles, how much longer do you think they're going to keep it at that terminal rate, that peak rate at the Fed in this hiking cycle relative to cycles gone by?
Yeah, so we looked back at the last 4, 5, 6 hiking cycles, all kind of the modern hiking cycles that you'd think of. And a couple things stood out to us. One, the Fed never stops hiking rates when the real Fed funds rate is still negative. So just to put it out there, the real Fed funds rate is still minus 6% if you deflate it by headline CPI. So they still have a lot more to go. But in terms of how long they're going to keep policy in restrictive, on average, we see that the Fed keeps rates at that terminal rate for about 7 to 12 months, so about a year. And we think given the magnitude of the inflation problem, given the fact that the unemployment rate actually continues to tick down despite, we'll watch initial claims later this morning. And so we expect them to be more in line with the historical average of the last 4 tightening cycles.
Well, while we're looking back at history, let's talk about the 70s as well, because I noticed some research out of Barclays on credit earlier this week, essentially saying when you look at this inflation and growth environment, it's most akin to 1973 to 1975, 1978 to 1980, both periods which were not good for credit. And they say this time isn't going to be different. Will it?
We are a little bit more cautious on specifically high yield, given the retracement we've seen. There are probably some things that are going to put some resistance below 400 on high yield spreads. One, we do expect that issuance is going to start picking up. Also, if you break it down between the categories within the high yield, one of the areas where you're going to really need to see a lot of retracement to get spreads materially tighter would be triple Cs. And these lower quality companies are starting to feel the pinch of higher prices, higher interest rates. And so, where we're more focused is in short-dated investment grade credit, so higher quality, as well as short-dated securitized credit. These have better break-evens. They have better all-in yields. We can feel more comfortable with the credit quality. And if you look at how they've performed in this rally, they've kind of lagged relative to the U.S. high-yield market.
Where would high-yield spreads need to get to in order for it to look attractive?
Well, back in June, we got around 600. And at that point, we thought that we were at least starting to price in and get compensated for those risks of a harder landing for an increase in defaults. Now, I don't want to ignore the fact that on a high level, credit fundamentals are still extremely strong. We're starting from a very good point for both investment grade and high yield companies, high cash balances. They've termed out their debt. Their leverage is on track and looks good. Relative to pre-COVID. But we do have to realize that where we are in the cycle, things are going to deteriorate from here. Margins seem to hold up actually better in this last earnings report, but we do see that that's not something that's going to be sustainable as inflation pressures remain.